Hi, this is John Bainham from Retirement Income Group and Evan Lagakis from Retirement Income Group as well. You'll say hi, Evan.
Hello, everybody.
Hi. And today we've got two of the portfolio managers that we've got a great relationship with and that we've been using in our portfolio for a while, Mark and Etienne. So today we're going to go through a little bit of questions around, what's their process, what's going on in the markets, what are they seeing, and kind of what does the future of fixed income look like in Canada in a low interest rate environment. So I guess to kick it off, if Mark and Etienne, do you want to introduce yourselves for, maybe 30 seconds each, just a little bit about your background? And
Absolutely. So prior to becoming a portfolio manager 13 years ago, I worked mostly on the institutional side in fixed income. So traded most fixed income securities, managed over my career, trading, sales, origination, research, lending, et cetera, worked at BMO Nesbitt Burns, Goldman Sachs, and TD Securities. And my whole process around managing fixed income is basically doing things that I think make sense. And as a bond trader, what we do a lot of is just basically taking risks that we think is sensible within the environment. So we're very focused on risk management, and we're very focused on absolute return. And so that's a little bit of my background. Etienne, why don't you tell them a little bit about yourself?
Yeah, sure. I'm trained as an economist. I started my career at the Bank of Canada in 2008. It was a good time to be there. There's lots going on. The financial crisis was a good learning platform. I then did my MBA at U of T at Rotman School of Management and joined our predecessor company, Sprott Asset Management, where I did North American equities within derivatives overlay. So I learned a lot about options then and other derivatives. And since 2016, I've been working with the fixed income team at Ninepoint, applying some of these derivative strategies to our fixed income products.
awesome, great. And so let's talk a little bit more about your process and how you manage credit and duration through an entire business cycle.
Sure. Well, so first of all, we're very different from traditional fixed income. So the type of mutual funds that most investors buy, or ETFs that most investors buy, are based on an index. And in an index, just buys, the market cap weight of just about every security that there are. So they tend to become too concentrated in a couple of things. They tend to be too concentrated in companies that need to borrow a lot, and they tend to be too concentrated in low yielding securities. So, I mean, a typical index fund that's based on the universe probably has 70% government securities, which in this environment, we really don't think makes a ton of sense, primarily because governments just don't yield anything. So it's a lot different managing money now today than it was, 10, 15 years ago, when a government or a quasi-government actually had a yield associated to it. So for us,
when we're talking about yield, just for people who don't know, that's the interest rate that you would get on the bonds that you're buying from these portfolios.
Well, so when I say you don't get paid anything, like a 2-year government of Canada bond now yields about 25 basis points, so less than 0.25%. A 10-year government bond yields basically 75 basis points. To put it in perspective, we could go buy a Royal Bank corporate bond that yields just almost 4%. So governments really, really don't yield much. I mean, if we go back 10 years ago, a government had a yield, of 4.5%. So they yield literally nothing these days, just primarily because there's been interest rates have been cut to the bone, and governments are now employing a lot of quantitative easing, which means they're buying that debt back. So what's happening is the risk premium, or the risk in owning government debt, has just basically gone down to nothing because you have another big buyer in the market. So our point is that the way we manage fixed income is that we really separate interest rate and credit risk into two distinct buckets. So when we respect that we want more duration, we buy more government bonds. And when we want more duration, it's primarily when things are going down, the economy is going into recession, or we are in recession where we think interest rates will potentially go lower. But when we're in an environment where we think interest rates are going to start going up because things are getting better, we're moving out of the recession, we want as few government bonds as possible. So to give ourselves quality and to give ourselves ballast and to give ourselves flexibility, we use governments to manage our quality and our duration, our portfolio. If we don't think it makes any sense to own any governments whatsoever, we actually won't. Like if everything's good, the economy's expanding, we don't have a lot of things to worry about, we really won't own a lot of governments. And then
Right.
we separate.
And I think for a lot of people, they don't necessarily get. Can you maybe explain how the governments like kind of offset or why you would own governments in a risk off period? You know, things when the economy aren't doing well and things like that.
Right. So when things aren't doing well in the economy, interest rates are going down. So we get capital appreciation out of our bonds as interest rates go down, but they're also the most highest quality yielding asset out there. So consequently, it's really what you want to give yourself protection and insurance in your portfolio. So you like more governments when interest rates are going down. You like more governments when you're in an environment where people are taking risk off and they're looking for risk-free assets, riskless assets.
Yep.
So the opposite is true with credit. So the way we think about credit is when we buy credit, we get paid an additional spread over a government bond. And the easiest way to look at that is it's like an insurance premium. So when things are not so good like right now, you require a bigger insurance premium to own credit because the risk of default goes up, the risk that these companies don't do as well goes up. So you get a bigger risk premium in credit during a recessionary environment. So the timing is, as you think you're coming out of the recession, what you want to do is transition. Etienne has a nice little chart here that he can walk you through, but we want to transition out of governments and move into credit. You want to talk a little bit about this chart, Etienne?
Yeah, sure. So we're all about being active, as I think you can appreciate from Mark's comments. So you want to directionally position the portfolio into what's going to give you the highest risk-adjusted returns over the next 6, 12, 18 months. So this little matrix here shows you what our playbook is depending on how the economy is doing. So we keep a lot of focus on how the economy is doing, what central bankers are doing. Are they cutting rates? Are they raising rates? And that kind of tells you where you should be going. When central banks are done raising rates and the yield curve is very flat, like we had in 2019, or late 2018, early 2019, it's time to start taking risk off the table. So we start buying more governments, we keep interest rate risk and credit risk low in the portfolio. And then, when the recession hits, central banks cut rates, we buy more government bonds, and then so on and so forth. So it's all about moving the portfolio in the right direction as the economy changes.
So we're in essence we're trying to be directionally accurate, and why that's different is most managers and most fixed income that investors buy, they just have a static portfolio. They don't move the characteristics of that portfolio around as well. So in an environment where you're going into recession, they benefit because they have a lot of governments and a lot of duration. But in an environment where you're coming out of recession, where interest rates are going up, and you want to own credit, they don't really benefit from that.
Yeah, that's perfect. And I also think that's a good segue kind of into our next question here, which is where, a lot of the bond funds that we've looked at and we've reviewed over the years, a lot of times they focus on paying the highest interest payments possible out of the fund. And I wanted to touch on a little bit, how does focusing on interest rates or yield that the portfolio is paying, how can that actually lead to more risk in a bond portfolio? Or how is that riskier in a bond portfolio?
Yeah, so we've got a couple of good slides on that, so that we'll flip to. So as I explained, government bonds don't really have a lot of yield. So what I mean by that is their benefits are deteriorating. And yes, they're a safe asset, and yes, they're high quality, but the problem with them is they don't generate any yield anymore. So if you own them, there's actually a penalty because you could own things that earn a lot more. So the reality of it is that you need to own more credit. You need to employ different strategies. You need to have less liquidity in an environment where you want to create more return. The problem with that is that as you change your security mix, as you become more active, as you take liquidity out of your portfolio, anything you're doing to generate more return has a direct impact on volatility. There's just no free lunch. The only way for a bond manager, the primary ways for a bond manager to make return are they use more duration, or we use a lower quality of credit. So that's basically what it comes down to. So I basically lined it up right here. Like if you're, our expectation is that a typical index mutual fund ETF over the next 12 months, 2 years or something, will probably earn around 1%. I agree, it's a high quality, it has a lot of governments, but you're not going to get a lot of yield out of it. The type of things that we do, more actively managed, your return profile is somewhere, 2 to 3.5%. Now, when we launch a liquid alternative that gives us the benefit of leverage, we think the return profile of that when we model it is more like 3.5 to 5.5. And an OM fund, which it basically means you have the ability to do whatever you want. So there is the ability to take more risk, will generate 5 to 7%. We have an OM fund right now that's up over 10% this year, but it has a volatility, which is a lot more than what you get out of a typical index bond fund. So the question is, if you want more income, you have to accept more risk.
Yeah, for sure. Yeah, thanks for mentioning that. And then also for people that don't know, we've mentioned duration a few times. I mean, duration is really the interest rate sensitivity of a portfolio. So how much volatility you get when interest rates change.
Correct. And there's two types of duration. There's duration in governments, which, as I said, you want in an environment where rates are going down. But there's also duration in credit. That means you're buying longer term corporate bonds. They have even more volatility than a longer term government bond, primarily because they're credit, right? So, and again, as I said, the way we manage it, we separate out the two. When we want credit risk, we use credit. When we want duration, we only use governments. We don't use longer dated credit.
Right.
And that's a way to cut volatility out of the book, but add income.
Thanks, Mark. Another question I think people might really get some use out of in terms of looking at yields and such. A lot of people, when they think about a bond portfolio, they think about interest rates and as a source of the income of the portfolio. Can you please expand a little bit on the idea of the capital gain in a bond portfolio? Because most people don't associate that with bonds typically.
Sure. Etienne, I'll let you take that one.
Thank you.
Yeah, sure. So in the environment we've seen this year, for example, a lot of the gains, the reason we bought government bonds, for example, is not because we were excited about the 1% we could earn or 1.5% we could earn in the income that it generates for us in the coupon that we receive every 6 months. The reason we bought government bonds this year was because interest rates were collapsing because of the pandemic. So as interest rates collapse, the value of that income stream from that government bond goes up, and then the overall price of the bond goes up. So most of the gains that we've had in our portfolio this year were capital gains because interest rates went down. So it's very different than how much current income you receive every time you get a coupon. So capital gains in a year like this year are very important. In other years where interest rates are more or less flat, or even when interest rates go up, then you don't have any capital gains. You more likely have capital losses, and then the income that your portfolio generates makes a big difference in your overall return profile.
Good. Thank you.
And one thing I would say is, again, unlike static bond funds, as an active manager, we like to take profits. So, we have a saying about bonds. They, when they go up, they probably only go up, 5, 10 points. But if, in high yield, for example, they go down a lot more than that when they go down. So anytime we have something that we think is done really well, maybe it's just like a stock, maybe it's done beyond what we think it's worth, we're not afraid to sell it and harvest capital gains. So we do take capital gains very frequently in our portfolio. It's not just about generating income.
Yeah, and I think that's,
and unlike equities, the earnings or the dividends never grow. So at some point, you squeeze as much juice out of the lemon as you thought you could. It's time to sell it. It's not like stocks that can keep going up because earnings are growing.
right. And I was just going to say too, I think another point to just make explicit is that bonds trade. I think the typical person we've talked to from our client base come into an association with us just thinking Canada savings bond, hold it for 5 years, get the coupon and so forth. But I think what a lot of people don't realize is that the bond market is many times bigger than the stock market, and these things actually actively trade the way a stock would. And sometimes we have to explain that in some detail because that makes no sense to the average person. I would say, just generalizing, obviously, but
yeah, which is very true. I mean, a lot of people, you're bang on. A lot of people don't just understand. The bond market is way, way bigger than the stock market. And by the way, the bond market trades 24 hours.
Yeah, good point. Yes.
Yeah, that's great. I think that kind of leads into, we might have answered some of this next question, which is, how do we achieve risk-adjusted returns in a low interest rate environment? And I think you've touched on this a little bit, and I think it's getting a mix of capital gains from the bond portfolio as well as interest income.
Yeah, well, but I would say, for us, it's all about the way we manage money is that we always have an eye on what type of income we want to receive and we want to make in the portfolio. And Etienne's got a profile of different securities that have different yield associated with them. But to be clear, the securities that have more yield associated with them definitely have more risk. So for us, it's always about, toggling back and forth between the types of securities that we have in our portfolio, all the risk factors that are in our portfolio, toggling back and forth, consistent with the market and consistent with the environment, the economic environment, and what's going on. So the big question for us, and this is probably a good way to put it in perspective, we were very conservatively positioned coming into this year. So we didn't have a lot of credit risk. We had more duration. We had a higher quality portfolio. And then that big shock happened in March. And then all of a sudden, securities get priced very, very cheaply. And then you look and you go beyond the horizon, you say, things are going to get better someday. But lo and behold, we're being shown securities right now that are pricing in a very, very dire environment. So to us, that's a great opportunity to buy. So we can pick up higher quality credit that has been very, very distressed in that environment, which for us is you get better risk-adjusted rewards. So we look at it, we say, well, let's not take a ton of risk. We only have to take a little bit of risk because things have been really distorted in this environment. And we also think that going forward, things are going to be better someday. But let's just start with, the higher quality stuff that's been really beaten up. And then as we go through, that recession, which we are right now, and we say, okay, things are slowly starting to get better. We may have not got some of, the higher yielding things at the bargain prices, but we feel more comfortable buying in that environment right now. And then at that point, we'll start looking at those because we say, well, we're almost out of the recession. These things aren't as cheap as they were, but we're more comfortable with the environment. So it's all about positioning our portfolio actively to be, where we think we need to be relative to the environment. So that provides a little bit more income, but with way, way less volatility, which as a fixed income manager, we think is the most important thing for us, is to give you what return we think is consistent with not giving you a lot of volatility. What I mean by volatility is that when you want your money, you don't want me to have to say to you, well, I'm down 2% this month.
Yeah, and I think there's something to be said too for the nimbleness. You know, a lot of bond funds, they become too big and they're not actually able to make some of the moves that you're describing.
Yeah, well, most of the bond funds that we can compete against us are 20, 30, 40 times as big as us. So they don't have the flexibility. But the other thing about it is that we tend to be a little bit more nichey. You know, we find things that are very interesting. But for us, you know, if it's a $5 million or a $10 million piece, I mean, it sounds a lot, but you know, we don't run 20 billion. So the bigger managers won't even waste their time on something that's really interesting because it's too small. And for us, it makes a difference, right? And it's the same thing. There's a lot of good companies out there that are really small, but the problem with them is they're not big enough for the big managers, so they won't look at them. Well, for us, we look at anything, and we're looking for a good company that has great securities. The size doesn't mean anything to us. So, you know, we tend to find a lot of things that a lot of bigger managers won't focus on.
And that's really keeping in line with how we manage our clients' money too, is just being opportunistic and nimble. So that's a really good asset we have with you folks, being able to move around that way, and the flexibility that you have inherently for that reason. So that's great.
It's great. And then I do want to touch on as well, you know, insolvency risk in the bond market, and then a little bit on, you know, what do you think is going on with rates, the current portfolio positioning, because a lot of talk about, well, how are these companies going to survive? You know, many of these companies without cash flow, are bankruptcies going to increase? And what's kind of the impact on, you know, maybe rates, the economy in your portfolio?
Well, I'll let Etienne talk a little bit about you know, credit risk and our view on you know, where the risks are, and then I'll talk a little bit about interest rates. So Etienne, why don't you talk a little bit about, you know, credit default rates, what we're doing, what we like, what we don't like, and what we actually think is an interesting way to play it.
Yeah, sure. So just a little bit of perspective first. So I've put up on this slide here what's the downgrade, the default rate experience we've seen so far this year in high yield. So that's US and Canada. So year to date, about 7% of the high yield universe has defaulted. Whereas in investment grade credit, we've seen no defaults, but historically, over long periods of time, about less than 1% of triple B rated companies ever default in the next year. So that's a very, very low default rate. So that's the main reason why we focus on investment grade credit at this point in the cycle. We like companies that have a bit more wiggle room on their balance sheet, if you want. Companies that are less likely to get in trouble. And one particular subgroup of these companies that we really like is what we call fallen angels. So fallen angels are companies that used to be investment grade credit and that were downgraded because of the economic environment. So we've seen a significant amount of fallen angels in this cycle. We probably will see more as the second wave of COVID hits. But so far this year, there's about $300 billion of bonds that used to be rated investment grade and now are rated high yield. The reason we like these fallen angels is that a lot of the index funds, once something becomes used to be investment grade becomes high yield, they have to dump it. They're forced sellers, and typically when there's a forced seller, there's a few bucks to be made, and typically that's when we show up. We buy things that others don't want, that in our opinion are overly discounted. So that's one space where we've been very active is in either the split rated or the fallen angel space.
Yeah, and an example of a fallen angel, recent fallen angel, was Ford. You could have bought 10-month Ford, and Ford used to be an investment grade company. You could have bought 10-month Ford in March at 13%, which is crazy.
Which we bought a lot of.
Yeah. You might also talk about, Etienne, the Bank of Canada and the Fed.
Yeah, so another reason why we like investment grade is we never used to have that in North America, but the Federal Reserve and the Bank of Canada are backstopping the investment grade market. So they have facilities in place to buy these bonds if the prices go down too much. So having a large player in the market backstopping credit, investment grade credit, is a huge benefit. So could we have more volatility in the market? Possibly, but everybody knows that there's somebody that's going to be the buyer last resort. That's not the case for high yield. So that's another reason why in the current environment we favor investment grade. There'll be a point where high yield is more interesting, but we kind of want to get on the other side of this pandemic before we start looking at high yield again. Mark, you want to talk about rates?
Yeah, for sure. So for interest rates, there's a few things. The first thing is all central banks are telling you that they're going to keep interest rates low for the foreseeable future. And they have a massive influence on the direction of interest rates. So until we see inflation, which it doesn't look like we're going to see anytime soon, or until unemployment goes really, really low, it's inconceivable that any central bank is going to be raising rates. And if central banks aren't raising rates, it's going to be very, very difficult for interest rates to drift much higher. The other reason I think that interest rates are going to be managed lower is that the amount of deficits, the size of deficits, and the amount of debt that is being issued because of this crisis, I mean, it's just inconceivable that any government or central bank would have any interest in interest rates going up, primarily because the cost of servicing that debt would become too much. So I just don't understand or see how interest rates, those are two very, very strong forces. I just don't understand how anybody, any government, any central bank is going to tolerate interest rates going higher. And the interesting thing is that if you look at the ECB, they have not raised interest rates since 2011. And they raised them once in 2011 and then basically had to cut them drastically after that into negative territory. I just don't see, I mean, I look at this as being exactly the same scenario. I just don't see interest rates going up here in Canada, North America, for another 4 or 5 years. I mean, we're really going to be in a low interest rate environment. And if you think it's about it simply with the pandemic, I just don't see life going back to normal anytime soon. I expect that unemployment is going to stay high. I expect that growth is going to remain low. And as I said, I don't really see a scenario for inflation. So, you tell me when we're going to get back to record low unemployment. You tell me when inflation is going to get back to 2%. And, I'll tell you when I think interest rates are going up. And even if you look at coming out of the last 2008 cycle, it was a long time. I mean, it was years before we got back to normal growth. So as I said, that's the bad news. I mean, it's unfortunate, but what else are central banks going to do but manage interest rates lower until we get out of this thing?
Yeah, I mean, they can only raise taxes so high before people get angry. And,
yeah.
I know we just had a vaccine announcement. It's a pretty good announcement from Pfizer recently. It's still going to take a while for them to really distribute that to everybody and get final approval. It's not going to be tomorrow or anything.
Yeah, but just think about, but even let's say, they have great success and they get it out in 2021, by the time you get it out and distribute it, it could be, mid 21, whenever. But between now and then, just think of the amount of damage that's going to continue to be done to the economy. There's record cases of COVID around the world right now. Europe is shut down. US has experienced absolutely the same thing. We know what's going on in Ontario right now. We're actually shut down. None of that is good. And, I don't see any light at the end of the tunnel yet.
Yeah, that's great. And I love the points you guys are making too about the government backstopping the investment grade market. And I think we've seen that in rates. I mean, in the US, there was it Ball that had a record low interest rate. They issued some new debts, even though they were a low rated company.
Yep. Oh, it's amazing. When we look at the yield on some securities now versus what we were getting 6 months ago, it's amazing. But you know, that's our challenge. And you know, I think part of it is that, like, I have this conversation with investors all the time. As I say, there's no free lunch, right? So there's ways that we can generate more income. It's going to come with slightly more volatility. You know, that's just the way it is. So investors are going to have to accept that, or they're basically going to have to accept lower returns. Or potentially the other way to think about this is, people keep talking about the 60-40 portfolio, 40 fixed income, 60% equity, or whatever the mix is. Well, potentially your 40 stays the same and you just have to accept taking less risk in your 60, you know, but something has to change.
Yep.
Did you have something there, Evan?
No, I think we've covered everything I wanted to talk about. I just, as I hear you answer the last question, it just comes to mind how, again, going back to the capital gain portion in this environment is really important, as opposed to just relying on interest rates the way we have in the past. I agree with you. I think we're going to be in this situation for quite a long time. And the Europe example is great. The other piece that that we point out to people quite a bit, and if you want to comment on this, is the loss of purchasing power. If you stay in a situation where you have a lot of cash over a long period of time waiting for things to change and so forth, just loss of purchasing power of the dollar as more and more currency is created and so forth. So I think this is why it's important to be positioned properly and do some of the things that you're suggesting.
Well, there's in fixed income, there's lots. I mean, fixed income is a more diverse market. There's more things going on. There's more things to buy. It's, you know, I've been doing this for over 30 years. It's way different than it was 30 years ago, but it's had to, right? It has to evolve. It always will. And people get fixated on, you know, government rates don't yield anything. I accept that, but we're also we're seeing opportunities that we never saw before. And I'll, like, we've bought securities that I think are very, very interesting. And I think that don't have the type of risk embedded in them that people may believe. The issue with it is they're not as liquid, right? So we did a very interesting trade where we got paid 11% on a security. That's awesome. I mean, that's a multiple of what you can get on a government. And I don't think there's risk consistent with earning 11%. But the issue with the security is it has no liquidity, right? So this is the other question that investors have to ask themselves. It's not just about taking more risk. It is a lot about that, but it's also about how much liquidity you want in what you're doing. And where you can dedicate some of your fixed income to what we say are alternative things that don't have the same degree of liquidity, you can get paid more, but you just have to recognize that when you want your money, you just can't get your money because these things are locked up into longer term, more complicated securities that just don't generate that liquidity. So it's not like that of course they're a little bit risky, but they're not super risky. What you're giving up is liquidity, right? And that's the big thing nowadays, is that investors have to understand. It's not just about taking more risk. It's also about how much liquidity do you need? And if you know, there's, like, think about things like private equity, private lending. Those are all interesting things. They lend to very interesting companies. They're very solid securities, but there's no liquidity in some of these private equity investments in the U.S. You don't get any liquidity for 5 years, but the returns are awesome. But you don't get any liquidity for 5 years. That's just what you're giving up.
Right.
Yeah. No, that's amazing. Yeah, thanks for adding that in. And I know we've gone through time here, so yeah, I just want to say thanks, Mark and Etienne. We really appreciate you giving us, you know, your time today. And yeah, we look forward to working with you in the future, and, you know, our clients as well. So
yeah, thank you very much.
Thank you.
Yep.
Thank you.
Awesome. Thank you so much.
Thank you.